Hello, everyone, and welcome to the Humans Behind the Handles podcast. In the coming months, through a series of conversations, we're going to speak with retail investors who come from a variety of different backgrounds and invest in various different ways. The goal of these conversations is to get to know the humans behind the handles, to show you that it doesn't matter who you are or where you're from. If you put in the time and effort, like our guests, you too can become a knowledgeable and successful investor. The format of this podcast will be such that we'll have a list of topics that we'll look to cover, but at the same time, we'll never let our agenda get in the way of a good, free-flowing conversation. We hope to give these investors a stage and a platform to show the world just who they are, how they got here, and what their process is. And now, without further ado, let's get started. All right, so the first question that I want to ask you, Dillon, is your Twitter handle and your Substack name is BluSuitDillon.
Yes.
And I really like that name. I like the logo that you got going on. For those of the folks out there that haven't seen it, you can look at Dillon's Substack and his Twitter, and it has his logo. I would love to hear, how did you come up with that? Where did that come from?
Well, two big reasons. Number one, I originally didn't ever want my employer to find out what my actual name was because I have a 9-to-5 job originally. So my thought process was, okay, I'm going to try to do this. I'm going to try to build this Twitter personality on the side. I'm not going to use my first and my last name, but I still have my identity out there. My name is Dillon. People have looked me up on LinkedIn many different times. They said, oh, there he is. And they've actually added me on LinkedIn. So my thought process behind that originally was just to create more of a barrier so people can't just go onto Twitter and figure out that I have, it, and it doesn't necessarily need to not go hand in hand with what you do with your 9-to-5 job, right?
Sure.
Because at the end of the day, what I'm trying to accomplish here is just investing for retirement. I've just chosen to take an approach of taking my own financial destiny into my own hands rather than paying somebody else to do it. So it's kind of like, it could be perceived as distracting, but at the other side of things, it's also something that everybody should be doing. If we all objectively think about it, like, what have you done for retirement? How have you taken control of your financial destiny? And then all I really do along the way is just share my thoughts and my research to other people to help them out. That's the only thing that I do. So essentially, the name was manifested by a perception of what a suit would be, right? So the suits on Wall Street. And I said, well, they usually all wear blue suits. It's like, I'll just do that. And I'll create a, it's not even really a company. It's like, I'll just create a theme name of Blue Suit and then Blue Suit Investing or Blue Suit Finance. And then that's how I got my name, was BluSuitDillon. And like I mentioned before, I use my real personality, my real picture on there and everything.
Yeah. So when did you make that transition to kind of putting your name out there?
Funny thing is, I'm actually a bald guy, right?
Okay.
So originally,
I'm on my way. That's why I'm wearing a hat. I'm on my way.
It happens to the best of us, man. So originally, I had my Twitter handle as the Bald Investor, and I had a bald eagle because I served, 4 years in the Marine Corps. So it's like, I thought it was funny. I thought it was clever. And then all of a sudden, I was just like, you know what? I think I had 1,000 or 1,500 followers at this point. And I was like, you know what? I am not going to be the kind of guy to hide behind an alias. I want people to really understand and know who it is that's talking about it. Like, and that I'm a real person. I'm not just a Twitter handle. I'm not just an account. I'm a real person that's tweeting their own thoughts and their perceptions on the stock market and just basic personal finance.
Mm-hmm. That's great. That's it's very interesting. It's I think a lot of people do hide behind, for a variety of reasons, they hide behind handles. I think some people it's professional, right? I know some friends that they have to because their employers actually don't allow them to have social media profiles. And it seems like that was kind of initially a worry of yours, but I love that kind of bringing it out again, like you said, kind of showing the world that who you are. And it's like, look, man, I'm not any different. I'm not special. Like, and I mean, I'm not saying you're not special, but you know what I mean? It's not like you are a suit or anything like that. That's kind of knows so much more than they are.
That's the most.
So if we could get into, Yeah. Sorry.
Oh, sorry.
Go
I
for it.
have to get this thought out there. I think the most important
Yeah.
thing is that right now I have about 15,200 followers on Twitter, and my Substack's pushing about 2,000 on my newsletter. And I just started that a couple months ago. Um, and I think that a lot of people perceive me as this, like the more followers I have, the more I know what I'm talking about or whatever it might end up being. But the truth is that I am not any way affiliated a part of banks like Wall Street, hedge funds. I have no formal training. Um, I'm a business major. That's about it. I knew how to read the financial statements on a balance sheet, but a majority of the things that I do, I am just an independent investor, a retail investor, and I've really taken the time and read a lot of financial books and really just found a deep passion and understanding for the financial markets. So I just want to make sure that I'm touching up on that. Is that yeah, man, I'm nothing special. I'm a student of the markets. That's the only thing that I am.
Hey, we're all special, but like you said, it's like to you don't, and I think this is something that my old boss used to say is that you have to know the difference between when you're lucky and you're good, and I think that especially applies in the markets because if you start thinking that all your successes are purely skill, you can quickly trick yourself into thinking that you are a genius. And look,
Yep.
we all get lucky sometimes, and that's okay. And like the part of the job in this business is to set yourself up and give yourself the best shot because things happen, right? Things with a company, all of a sudden they lost a client, they lost, they like SE left India today, something like that can kind of
Yep.
happen and kind of you have to set yourself up because there are so many unknowables in the market. If you can just kind of
Y-
set yourself up for the best opportunity.
and that's something that's so important when it comes down to stock picking is that one of the most important things to really understand for all investors out there. And I think that even money managers can learn this word because you listen to the talking heads on CNBC and Bloomberg. The one thing that they never say is I don't know, right? Or truthfully, I don't know if this trade's
It's
going to work
true.
out.
It's true.
But they're not paid to say that. But even Peter Lynch himself, Warren Buffett, the greatest investors of all time, they all say the same thing that if you're batting 60%, man, you're doing a good
Oh yeah.
job. So
Oh
when
yeah.
you think to yourself, like an independent investor, let's say you have just $10,000, right? And that's what you're going to get started investing with $10,000. And if you could just buy five stocks, put $2,000 into each stock, and you should be assuming to yourself, if you're a good stock picker, that's going to be about a 60% hit rate. But those winners are going to way outperform your losers. Like some of the losers, yeah, some of them might go down to zero. A lot of them may just see the valuation cut in half. Some of them may just trade sideways for a couple years. Whatever it might end up being,
Mm-hmm.
that's the process of investing is understanding that you are destined to fail. Every single
And
money
that's
manager on
and
Wall
that's
Street.
really hard. And that's really hard for some people to deal with.
Yep.
But in this
And
game,
that's
you
what a
have
lot of people
it's
say
if you
is
do,
go ahead.
no. I was just gonna say a lot of people have a really hard time with that in general because that's not kind of how we're trained as people, right? Like we're like we're very much in your job, you're not aiming for a 60% hit rate depending on what your job is. You're aiming for higher. Now maybe in sales or something like that, it's a little bit different. But like if you're a programmer, 60% is not good enough. So then people get into investing and they expect the same thing out of themselves, and it's not going to work because nobody can do that. It's not just you. It's not just me. It's nobody can do that. Even the best, like you said, Warren Buffett, Peter Lynch. You look at someone like Ackman, who has 20 years of hedge fund performance beating the market. He knows, and I mean, he would never admit this in public because of his ego, but whatever, that he does not have that kind of hit rate. And that's okay. Um, yeah, so if we could step back
Just
real quick, if we could step back and talk a little bit about maybe just college. I know you're in the military. Kind of how, kind of you just tell people a little bit about yourself, kind of how you came up, maybe where you grew up, and kind of where you are today, or well, at least maybe stop around when you maybe start getting into investing, and then we can kind of dig into that as well.
so I actually come from a broken home,
Okay.
and both of my parents were poor.
Okay.
So I when I was growing up, I wasn't really raised in a situation where I had much money, Investing was an afterthought. Trying to find money for food was the forethought. And over time, I ended up witnessing, after my mom ended up finding my stepdad, I ended up finding his success through his young career, and I watched it grow over time, from their mid 20s to about his 40s. So I had the fortunate I was fortunate enough to watch that sort of success be built through hard work, dedication, and a willingness to fail. So my background is one of just normal, average, everyday beginnings. And even the college that I went to is nothing, it's nothing special. It's a state college, right? So actually, funny story is that when I was in high school, my GPA was it was 1.7. Like I
Oh,
barely graduated high school. Yeah, and that's that's why I ended up going into the military right after. Now, don't get me wrong, it's not because I wasn't able to go to college, because I did go to college originally. It was a relatively good business school. It's the second
okay,
best in the state. And
okay.
I was smart enough to get in there. My ACT scores were good, but I just wanted to do something more than just sit down and learn a book. And I also
Mm-hmm.
always knew that I wasn't necessarily programmed to do something that a lot of people don't always think about, in the sense of, like, we think about this mundaneness of life, this dogma
Mm-hmm.
of life, right? So
Mm-hmm.
we go about our entire lives, we go to school, they tell us get good grades, they tell us to graduate school, go to college, get good grades, be a good little boy and go get a good job, and then make sure
Buy a
you
house
get
in
a
the
promotion and you work with
suburbs.
the, you
Yep.
buy a car, like get into this massive amounts of debt, and then you have kids and then you die. That's basically the way I perceived that when I was about 18, 19 years old, is I'm saying to myself, I am living what everybody else is telling me to live. And I don't, there's a big world out there and I just want to understand more of it. And that's a big reason why I ended up joining the military in the first place was, this call to adventure is probably the best way to
Mm-hmm.
think of it. And then when I was 4 years into the Marine Corps, is what I actually spent my time in, is I got out, and the first thing I knew is I wanted to go back to finish what I started in school. So as soon as I got out, first thing I did is I went right back to business school, and I actually made an act like, it was kind of an accident, is that I didn't take a math class for 4 years. The first math class I took was business calculus, and when I took that, I got an A in the class, and I was like, huh, I might be a little, decent with numbers. And
Yeah.
then, I graduated, and
Like,
then
hold on, wait a second.
yeah. Oh wait, no. Are you saying okay? Are you saying yeah? Okay.
No, I
So
was
I
just saying. Oh,
graduated.
you were like, hold on, wait a second. Like, this works. This works in my head. Like, this makes sense.
Yeah, yeah. I didn't. It was funny. I told my parents that at the time, and they're like, "Yeah, I don't know anybody that could do that." And I was just like, "Well, you know, it it was just one of those
I
things that
can.
came natural." Yeah, right. Because you work in finance, so you definitely understand, man. The numbers, they just speak to you. But I got a major in business management. Um, I almost went for a finance degree, but I thought that the finance guys were nerds. And I was just like, you know what, I'll go to business management and just be the best of all worlds here. And then I've been in sales. So that's what I do for my 9 to 5 job is just do sales. I've always been in sales. I've been in car sales, I've been in software sales, and now I'm in medical sales, and really
Okay.
moved up through the ladder over time. And then it's really gotten to a point when you start working for big pharma, it works out pretty well for you at the end of the day. And
Sure.
I'm in
Sure.
specialty as well, so it's just really good. So it's really that's that's really where the first question started coming into picture, is when I got into um, the sales world. I started to realize that I had this new concept called disposable income, meaning that I could either just blow it on something or I could just put it into a savings account. Once I started
Right.
to understand that, you know what, this doesn't necessarily seem like a good idea to just let it sit in a bank account. Like, it's not doing anything, it's not going anywhere. And I had a really hard time saving money. And so I paid off all my debt. And then the first thing I did is I bought JP Morgan, and the stock wasn't moving. And that's exactly what I ended up doing, is just watching the stock not do anything. And I was like, oh, okay, so I'm supposed to wait for a dividend next quarter or something. And then I was, just like every other retail investor, really wanting to pursue the action, right? Because
Hmm.
every single retail investor, when they open up their brokerage app, they see funny looking, like things are red, things are green, your money's going up, your money's going down. It's a freaking casino, man. Like, and it's noisy. And there's no
Hmm.
process, there's no thoughts behind it whatsoever. And the first thing that I did at that point was I picked up a book, and that's what I think that everybody should be doing when they're first starting out in investing. And the number one book to recommend is going to be Rich Dad Poor Dad by Robert Kiyosaki. And the reason why I say that is that it's not going to go into the mundaneness of finance. It's not going to go too much into the stock market. It's not going to go too much into how do you do this. It goes into why you do it, and understanding that why and that core principle of what's going on in this world and how important. Bloomberg just came out with an article saying that 50% of millennials are living paycheck to paycheck, and some
Yeah,
73% of millennials can't even pull out $400.
it's
If they
insane.
have a miscellaneous $400 expense, like my dog Aspen's X-rays were $400 the other day, and they looked at me like I was crazy because I just swiped my card. No big deal. It's $400.
Yeah.
But saw a lot of people would just go crazy.
So, like, that's a great point because I think it would be so tempting for a retail investor like for somebody that's not even a retail investor, but somebody that's new into this world of finance and investing to immediately go and grab a Warren Buffett or a Peter Lynch. But if you don't have the right, like you kind of said, the motivation, the right framework for everything, then it's harder to kind of frame things in your head as to why you're doing things, as to why it's important, why this is something you should be spending so much time on. And real quick, before again, we're definitely going to get into this, but when you were in your business major, were you ever exposed to the market in any kind of way? Was there
No,
any, was that no?
entry level accounting classes is all it was. I remember I used to walk by the finance area of the school, and they would always have like stock
Hmm.
charts and stuff. And I was always gravitated towards that, and I always thought that it was interesting, because you see numbers moving, and and it's the financial markets, and it's supposed to be, like this excitement, this rush, and adrenaline, and all that. So I was interested in it, but I never ever went through a class that taught me anything about valuing a business, that taught me anything about. I mean, the cash flow statement was just briefly touched on. It was like, hey, this is what operating cash flow is. This is what free cash flow is. Then you look at the income statement, then you say, okay, this is a gross profit. This is essentially what you end up like, basics, right?
The
Like you could
basics.
teach it to a high schooler, yeah, or maybe even a middle schooler in some cases. Um, so my financial education was very, very limited in the sense to where I never really did any sort of like valuation metrics. I did a lot of economics classes though, and that's a
Okay.
big reason why you see me post a lot about economics, is that was just something
Yeah.
that I was always interested in.
Are there any, so you kind of, you received an education in that and kind of got a base knowledge of that. Are there any books that you've read as it relates to economics for somebody that's maybe not a business major to help them kind of frame that for them, because nobody wants to pick up an intro to a macroeconomics textbook. I mean, it's probably how we learned, but it's not the most exciting thing in the world to learn. I mean, I imagine I wasn't super excited about reading it in college. They're just kind of dry books. But is there anything that you've read that you think would help somebody that was trying to frame this world in their head?
Yeah. First off, the books are terrible. I mean, I love reading
I would
about
guess.
mindset, money management books and stuff. But when it comes down to like reading about macroeconomic books or finance books, they're tough. They're tough because it works sometimes often in a world of absolutes. But the only thing that you really need to understand about economics is that there are laws of supply and demand. I mean, every single factor, every single facet, and it's all a system that works in supply and demand. That's the whole concept of the markets. You have supply, you have demand. Demand drives supply. Supply can over supersede demand, which drives down prices, things like that, right? So just basic economics, you could probably just look it up on YouTube. But where I really started getting into like macroeconomics in the first place was I ran across a couple different podcasts. is what I started. And I caught on to one economist called Richard Duncan. And his name, or Richard Duncan, is his website is going to be Macro Watch. So it's Richard Duncan Economics Macro Watch. And he started talking more in depth about the inner workings of the economy. And the first time that I heard this, um, and this is when I really started coming across it with inflation, when inflation started picking up. And I was like, no, it wasn't that. It was during 2020 when I started to realize that the markets were rallying. And I was like, why are the markets rallying? And I was very, very confused as to why the markets were going up in such a terrible time and the economy's closed down. And I had so many questions swimming through my mind, like, what is going on? Why are the markets going up, and why is there so much euphoria in the markets? And that's really where the process started, was 2020, because even like 2018, if you remember that was just chopping it up to the Chinese trade war. You know, we really,
Hmm.
as retail investors, didn't really think about the second level, like what was going on in the monetary system, like what is quantitative tightening, like how do interest rates really affect money markets, or the financial markets is what I meant to say. So it's like, and then
Hmm.
how does the bond market influence the equity markets, things like that. And then all of a sudden, I started to really get the picture of, hey, when you print the money through quantitative easing, then next thing, it boosts equity prices. And then equity prices drive this wealth effect. And this wealth effect essentially drives consumer demand. And that's when I started catching on to that. So um, for retail investors that are seeking to understand why the markets would work, or really understand how do how does economics drive the financial markets, or even how does monetary policy drive the financial markets, I think Richard Duncan was one of the best. He's probably the best economist that I could sit down and learn from, because he just explained it in a way that was like, it was real, man. It wasn't a textbook. It was like, for example, you're never in an economics class. No one's ever going to sit there and tell you, hey, the government's monetizing our debt and they need inflation, right?
Nope.
Schools won't teach that, but that's the
Mm-mm.
truth,
It
and
is, and
that's the
I
honest
think
to God truth.
you hit on a couple of great points there, and I want to highlight them. One of which is that, again, like we kind of said, it's so tempting to just go grab a Peter Lynch book, but if you don't have the right framework in front of you, like you said, if you don't understand at least the high level of how the economy works and things like that, it's so hard to understand what's going on in the market because you don't have that baseline information. You don't have that baseline of kind of, okay, like you said, monetary policy being the Fed and the money supply and things like that. Fiscal policy being spending in government, by the federal government, and then down in through the states. And if you don't kind of have that baseline understanding, it can be very challenging. And another thing that I love that you hit on there was that you were asking questions when the market was working, when it was going up. Most people, if things are working well for them, I think it's naturally, it's kind of human nature. You don't question it as much. You just like, oh, it's attribution bias, right? You attribute it to yourself. You're like, oh, my stocks are working, and it's very easy to ignore that. Well, no, everything's going up. It's not just the stocks that you picked. Everything's moving higher. And to ask questions, it's easiest to ask questions when things are going down, when they're going against you, because you have this pain, this kind of negative, kind of thing happening to you. Negative reinforcement. I was going for is that it's kind of it's hurting you, and you need to ask questions. You need to figure out why. And oh my God, this is my savings. Like, what am I doing? I'm losing all my money, and it's easy to ask questions then. But also when it's going up, that's also when things are moving higher in a stock or the market in general. You can learn a lot in those situations too. And I think that's a very interesting point to make. Um,
I think
so yeah, I mean,
I
I
did a
guess
tweet the other day.
yeah.
If you remember, I ended up saying that I did investing in the stock market is comparable to being a sailor, um, where a sailor who knows their boat and knows the capabilities of their boat isn't always good as the sailor that understands the weather, right? So when you go to sail across the ocean, you equally need to understand how the weather and like how the weather is going to impact your expedition, and not just the boat. So in this particular case, the boat is going to be the companies that you invest into, because those are your modes of transportation to get you from point A to point C. And then B is essentially going to be the expedition through that. Like, a great boat can still sink in a hurricane, right?
Even with a
And
great
that is one
sailor.
of the most important things. With the great sailor, a great boat, everything can be perfect and rosy. But if you get caught in the middle of a hurricane, that boat's going to collapse. And the vice versa also works too. If you only understand the weather and not the boat, it's going to be the same way. That's why economists are really bad investors typically, because they don't
Yes, they are.
understand the boat.
I think
So
that I
it's like,
love that.
if you really
I
want
love
to,
that analogy. I love that analogy because it is so much. Again, people, stock pickers that can know their companies better than anyone else, and yet then the macro goes against them. You can very quickly be wrong, and the same, and the opposite goes the same as well. I'm actually I'm a big fan of like sailing and boats and things like that. So I especially love that analogy. I have
yeah,
a
man.
dream of living with my family on a sailboat. I got deep into this like hole of reading about people that raise families on like 36-foot sailboats. Uh, and people do it. It's crazy. I aspire to it one day. I think it's really cool. Great way to see the world. And like you said, I think maybe it's that's actually I've never thought about it this way, but maybe it's similar to my why I like the markets. It's that I kind of view like sailing. It's like, yeah, you need to know so many different things. You need to know a lot about yourself. You need to know a lot about the boat that you're in. You need to know a lot about the weather that you're going through. And the same goes for investing. We all have emotions. We all get caught up and have kind of cognitive biases, and that happens in investing too, right? You have to know who you are and who yourself. And what there's a isn't there a saying that's like the stock market is the most expensive way to get to know yourself.
Oh,
You can very quickly.
yes, man. When you
So going
when you
back
were
to
in the
kind of how
stock
you
market, there's
how you
nothing.
yeah yeah yeah.
When you're in the stock market, there's nothing more that's going to test your will and your why more than that. I mean, when you're losing money, there's nothing more emotional than that.
But yeah, going back to how you started. So you started investing in JP Morgan, and you kind of saw it wasn't doing much. You said you kind of picked up you started picking up some books. And were you for somebody that's kind of getting into it, were you reading a lot online at the time? Were you involved at all in financial FinTwit? Were you looking at blogs, YouTube videos, or did you go straight for the book and start from there? Or kind of what was that
Uh,
process?
YouTubers, YouTubers, especially going to be what there's two that a lot of people know of. It's Meet Kevin and Jeremy from Financial Education. Those are both really, really popular YouTubers. And I wasn't really a big fan of, I think that, I can't remember that other guy that always has his like investing framework or whatever and tells you to put it into an index fund. No, the stock picker that appealed to me the most was actually going to be Jeremy from Financial Education. And I really grasped onto the process because he did have an open portfolio that showed that if you picked the right companies, you could outperform the markets. Not all of his stock picks were working, but it was so. And the thing is that his investing approach is, frankly, it's stupid, right? And I'm not insulting him by any means. I'm saying that it's so simple that it works, right? He finds good businesses and he tries to pay the right price for it. That's it, right? And I knew that that was the one thing that I could consistently. Here's another good example: is that my cousin opened up a paper trading account in August of 2020 because he was 14 years old at that time, and he's like, aren't you in investing, Dillon? And I said, yeah. And he's like, I want to get started. I'm like, open up a paper trading account. Let's put $10,000 in there, so you can understand what volatility is. Because
Mm-hmm.
then he could actually see the moments, and he doesn't have to be emotionally attached to it either. He just needs enough time and understanding of how these things work, right? And what he did is he bought a stock. He bought Tesla, of course, and he bought Apple, and he bought a couple of the other popular stocks, a couple bank stocks, and he didn't touch it. I mean, sometimes he do a little. some buys and sells here, but for the most part, he didn't touch it. And since August of 2020, he has outperformed the NASDAQ. Like that is something
Oh,
to be a
that's
15-year-old kid
yeah.
is outperforming the NASDAQ, right? And if you think about it, the simplicity of just buying a good company and holding it is the game that retail investors can play. And that is the core principle. Like I mentioned before, I really, really like understanding macroeconomics because I think that there's one shortcoming that Jeremy from Financial Education has, and that he's only invested into a secular bull market. You know, not understanding and realizing that a secular bear market can happen at any time. I think that's irresponsible for all investors. You know, because if you can't understand that your portfolio could realistically be cut by 75%, you know, if you're later on in life and you aren't understanding what's going on in the macroeconomic world and you're 50, 60 years old and thinking about a 75% portfolio cut because of a great financial crisis or a Great Depression 2.0 ends up
Yeah.
happening, you're screwed,
It
you
happened.
know? And that's
I
why
remember
everybody does.
I remember reading a lot of stories coming out of '08, and looking back, 2000, the tech kind of bubble in 2001 and such, in 2002. There was a lot of people. There's a lot of stories of people in their 40s and 50s that got completely run over. And if you don't have the time frame, and I think we would both agree, there's financial advisors out there that, preach diversification. And there's this whole, as you get older, you shift from bonds to stocks. And for a lot of people, that's not appealing. But I think there is some wisdom in it. Or at least if you're not going to do that, to invest in the equity market appropriately, right? To not be at 65,
Yep.
60 years old and invested in all Tesla and kind of more volatile stocks like that. You can quickly get yourself sideways and really ruin your life. And unfortunately, like you said, in terms of secular bear, like you have to be very aware of them and protect yourself. And a lot of people got very hurt by that in '08. A lot of people got very hurt by that in the tech bubble in the early 2000s. And it was very unfortunate, right? And if people could just be more kind of educated, more aware, and kind of thinking about these kinds of things, because it is so important. I mean, God, you're 55 years old and you lose half your savings. I mean, that can really mess up your life, unfortunately. Um,
Yep.
for what can be such a great thing, being investing in kind of the market, and making your money work for you and things like that. So you got started with YouTube videos. You got started with some books, and then I think I heard you before kind of say when you really got into it is when you had time, was in kind of the beginning of COVID, and you started asking questions. You were asking these questions, and at this point, at the beginning of COVID, were you involved in financial Twitter? When did Blue Suit Investments start? And you said you mentioned to me before you were kind of started a YouTube channel. Was that right at the beginning of COVID? Were you doing that beforehand?
Yep. So beforehand, I was really involved with my work. And like I mentioned it before, I was trying to solve the basic problem. What am I going to do with this disposable income? So it really was just a lot of passive ETF investing. Like I could at least understand that buying the SPY was a good idea, right? And that's essentially what I ended up doing. And I did the classic maxing out your 401k, yada, yada, yada. And then I saw that the markets collapsed. And when the markets collapsed after COVID, that's when I figured to myself, okay, this is probably a really, really great time to expand my knowledge and like my participation in the financial markets, right? So that's essentially where I really got started is, well, I started to really ask myself questions. And more importantly, it was the time that all of us, it really reset a lot of the thinking around there, right? A lot of thinking in the financial markets in general, because it did feel like, I remember watching everything go down, and I was relatively unemotional about it, right? I was just like, whatever, I know that it's going to go back up. I was paying attention to the news cycle, but not nearly as much as I do now. And the only thing I thought to myself is, and I was making about six figures, over six figures a year at that point, and I had like little to no debt or anything. And then all of a sudden, I'm supposed to stay at home, and I'm told as a sales guy in medical sales, like they weren't letting us into clinics. And even the companies that
Mhm.
we would work for, so like all the medical clinics, they were just like, dude, you're not doing anything. So I had 2 or 3 months and my mind was going nuts. And the only thing that I could think of was I just start picking up books and just reading and reading and reading and reading. And I think a couple of the books that I really started, that I listened or that I read right away was Rich Dad Poor Dad. That was the first one, and that was just like, whoa, mind's open. Cash Flow Quadrant was the second one. One Up on Wall Street by Peter Lynch. Then I started reading How to Make Money in Stocks by William O'Neill, and I realized that that wasn't necessarily that much my style, but there was a lot of great principles to be learned. Trading in the Zone was another one that I ended up learning or reading. Um, I probably can't even tell you how many books I've read because I think there's just a couple that really stuck out to me, and 100 Baggers was another one that really stuck out to me as well. So that's all I really did during that time was just read and just learn how this stuff really works. And like I mentioned before, I have no real financial education of going into a hedge fund or learning from somebody else. I really had to take this time and this opportunity to, this time that we were given during that crash and during the COVID lockdowns and working in healthcare. I didn't have anything to do. And I took all this time and this money that I had that was disposable because I wasn't spending money on the restaurant industry. I wasn't spending money on goods or anything like that. I was sitting in a house. We were all sitting in a house. We were like,
We were
well,
all.
markets are going up, right? so, so I just kept putting money into the markets, putting money in the markets, and I just watched my portfolio grow. I mean, it was insane. It was absolutely insane. And then, um, I made the typical mistake as all retail investors did during that. Well, not all. I'd say a majority of retail investors did. I got caught up in back-to-back bubbles, and I think that the second bubble with the growth stocks, that one was less obvious. It was obvious, but it was less obvious because at least these companies were generating free cash flow, but the valuations were just so extreme. Um, but in early 2020, that SPAC boom, that was like, man, I remember when I saw Lucid go up from $10 per share to 80, and I'm like, they don't even, dude, you don't even know what the valuation is right now, man. Like, why are you
There
buying
is no
this stock?
valuation. There
That's
was no
so
valuation.
or like the space stock, man. There were so many companies that
Oh,
didn't even have
space. That one drove
nothing.
me nuts.
Dude, there was no hope in God's green earth that a majority of these companies were ever going to be profitable. And I knew that I was relatively new in the financial markets, but I wasn't stupid. I was like, I'm not going to buy that stock. That's crazy. So, I mean, like I mentioned
I
before, man, I
yeah.
don't know how I've really grown my following as much as I have. It's just kind of learned over time.
I think you're being genuine. You're being honest. You're putting out there what you're learning, what you see, and how you do it. You're not just trying to generate content that you know will be popular. You're not just following the stocks that everyone else is following, and you know that a lot of people are searching the tickers and ways to do that. You're letting your process guide and not letting social media guide, which I don't. I'm sure there are people that go into it intentionally doing that, but I don't want to. I don't want to cast that on everyone. But I think it can kind of be natural, right? There is social media does kind of provide like a dopamine hit, right? You get more followers and you get people commenting and liking. It's a dopamine thing, like right? You're chasing it and it feels good and those kinds of things. But to allow that to kind of get into your investing process can be very dangerous because then you can just kind of end up with the tide, and when the tide comes out, as the saying goes, you're naked. You find out who's naked, and if you don't really know what
Yeah.
you're invested in, that can be very difficult.
And that's a big thing that ended up happening with this latest bubble is that with a lot of these growth stocks, I mean, realistically, you look at companies like Datadog or even Snowflake and Zscaler and a lot of these really, dude, they are literally game-changing companies. Like wonderful, like Datadog's free cash flow margin, I think it's somewhere between 20 to 25%, right? Just because they don't have GAAP earnings doesn't mean that they're not profitable. It means that they're not showing profitability, and they're just cash beasts. And the valuation just got ahead of themselves. And now nobody even wants to touch these companies. And they don't want to touch them because they're afraid of what just ended up happening. But if you realistically think about the long-term potential, like, sure, yeah, I got hit. And I'm not going to be here to tell you, I found a way to somehow maneuver the markets and not lose a significant portion of my equity. I'm not going to say that because I'm a buy and hold investor, right? I'm not trying to play Wall Street's game. But I'll tell you what, though, man, that was one of the best lessons that I learned, that it matters what you pay, but when you are caught up in things with the financial markets, that is one of the most important lessons, is that the herd is always wrong, right? And I'm thankful that I had the opportunity to go through both of those lessons, because when you did see, like, and it's Wall Street too, right? It's the Wall Street herd and it's the retail investing herd. Both of the herds are wrong. And typically when you start seeing this flow of money into certain equities, and the thing is that people, investors that bought these really great companies that did have a positive operating cash flow or free cash flow, like D-Local is another company that I own right now. Dude, their NRR is 198%. They're growing 124% year over year. And then their EBITDA margins are 40%. You mean to tell me that because I ended up building a position at $50 per share and it's trading at 30 these days, am I a bad investor? Or was I just building a position at the wrong valuation at the wrong time? And that's what I started to think about during this latest sell-off, man.
I think it's tough, right? I think so. I can speak for myself. Kind of coming out of the professional money management world, it's almost like sometimes I don't want to say like knowing too much, but I was looking at what was going on in the markets. So I came out of the professional money management in mid to late 2020, and saw what was going on, like you said, with these bubbles and these big growth stocks and like things like Lucid and all these SPACs and everything. And like I don't claim to be any kind of expert. Just because I was in the professional money management world does not I do not claim to be expert. We are all students of the market. We are all trying to learn and we are all trying to get better every day. And I was sitting there scratching my head, wondering what the heck was going on. Like none of this
Yeah,
makes any sense. Valuation, but you know what? It happened to me too because I started thinking what we kind of talked about before. Maybe we talked about this offline. Is knowing the difference between you're wrong and when the market's wrong, and being able to tell the difference between those two things. So I started looking at the market thinking that I was wrong. I was like, maybe the whole valuation framework has changed. Maybe you pay 30 times sales for software companies now. I don't know. Like, this is crazy. Like, Cloudflare trading at one point was trading like 100 times sales. Like, maybe that's just
110.
the way it is now. 110 times sales. Maybe that's just the way it is now. I feel like something's broken, and I needed to trust myself. And I wasn't invested in those kinds, but I did get run over in a few stocks, and they were luckily for me, there were smaller positions. But when a small position is down 70%, it can still hurt a lot. That's another thing
Yeah,
that is a hard lesson sometimes. You're like, oh, I'll size it correctly. It'll be 50 basis points. It'll be 1% of my portfolio. But when it's down 70%, it still hurts.
yep.
Which is a tough lesson to learn sometimes. So you brought it up, and maybe this is the answer, but I'm sure we all make mistakes. But what if you were to kind of talk about one mistake that you really learned from one mistake that you felt you made? Maybe it's a macro, maybe it's kind of you kind of talked about secular bear markets and they can happen. You need to be prepared and you need to understand, or if it's with a single name stock. What was like one big mistake that you learned through experience that kind of sticks out in your mind?
Man, I love that you asked this question. And I think it's probably the best question you could have asked. And the reason why is that this is the whole point and reason and rationale why I've completely changed the way that I'm producing content. My number one mistake was that I didn't trust myself. I knew the principles, and I'm not sure if you saw this, but in November 10th of 2021, I said the coming market crash, and I posted about it. And I
I
said
read it.
valuations are way too high. I said the Fed's printing a bunch of money. They're about to go through QE. Every single time they've ended and they've tapered, markets have sold off substantially. And I didn't bail out of stocks. And I didn't bail out of stocks because you said it best before. You said, maybe it's different this time. Maybe the market is right and I'm wrong. And I had all these investors on Twitter talking about how this is the valuations don't matter. And I should have, my red flag should have been thrown up and everything like that. And by this point, I understood enough in the financial markets to understand really what was truly happening, but the market was moving in a different way, not validating my thesis, not validating what I originally thought. And because I didn't have that, mentor that could potentially show me, like, dude, you're being an idiot right now. And I was by myself with nothing more than Twitter and confirmation bias echo chamber. What I did is I did exactly what I shouldn't have done, and that was not trust myself. I should have trusted myself, and I knew better. And I got caught, excuse my language, with my pants down because I didn't trust myself. And that's why every single thing I do is that I have made it a point, and I have made it a very clear decision that no investor, as they follow my content, will ever, I'll tell them about the stocks I like. I'll share my research with them about the stocks I like. But I will never ever post every single move in my portfolio, and I will never ever again post my returns or anything like that. And the reason why I'm never going to do that is because they can choose to listen to me or they can choose not to listen to me. I don't need to do it for money. It is a paid portion of my, yeah, it is paid, but that's because my time is valuable. So like a lot of the research that I do, the publications that I do, it's like that's a lot of work and that's a lot of time. So yeah, do I think that there should be a paid portion to it? Yeah, and I give away a lot of free stuff as well. But the thing that I want investors to know and to understand the most is the most important lesson that I learned, and that is, you have to understand this. You have to know what you are doing. And if you are making mistakes, that is nothing more than a learning lesson. Don't risk more than what you are willing to lose. You have to know what you're doing. You have to understand. Like I said, I can prove to you by the things that I talk about that I know what I'm talking about, right? I can post these macroeconomic picture or these macroeconomic in detail Substacks that I know that even professional money managers would be like, hey, what the hell is this guy even talking about? And I can also talk about the stocks and say exactly, I'm sharing my entire investment process and I'm going to make it free. And I can talk about every single last detail that I talk about, from market analysis all the way down to the individual bottom line metrics and top line metrics, why they matter, what to look for competition, why you should be identifying stocks and given market opportunities, why valuation matters, how to value a stock in depth, right? But I only want to teach people how to fish. I don't ever, and that's why I'm saying I'm not going to post my returns. I'm not going to post my current portfolio because I'm giving people fish. I don't want to teach. I don't want to give any more fish. I want to, and especially when that fish goes rotten, I don't want to be held liable for it. I want to teach people how to fish so that they can understand and take control of their financial destiny. So inadvertently, with the process that I have, the lessons that I've learned, and the content I create all work together in the sense to why I do what I do. The whole point of why I do what I do is to help people, because I don't live paycheck to paycheck, right? Sure, I lost some portfolio equity, but I make hundreds of thousands of dollars. It doesn't matter. And I'm 31. It doesn't matter. I have 30 more years of solid investing experience, and I'm just getting started today. This is the time to make these mistakes, right?
Mhm.
Understanding what bubbles look like, it's the time to make those mistakes. But every single month, every single year, I go along and I fail and I make bad choices. I make bad stock picks. But every single time, I consistently learn, get knocked down, get back up, and rebuild. And I just keep that going on. And the number one thing that I got to say, man, is stay the hell away from margin. I got caught blindsided in 2021 at the first bubble pop. Oh my gosh. I think
I
I
think
lost.
I think there are professional money managers that could learn that lesson, and there's plenty that we've seen blow up, and there's plenty that we've seen fall apart. Student of the market. I mean, going back like long-term capital management in the late '90s, just levered to the hilt. For those that don't know about it, it was a quantitative algorithm trading shop back in the 90s. It was all PhDs. It was all, these like very intelligent academics, and they thought that they had figured it out, and they knew more than the market, and they blew up epically. Historically, they blew up. So it's funny. It's even the smartest people. It's like you get lured in, and supposedly the smartest people get lured in, and they just don't exactly. It's hard to humans seem to have a hard time with like tail risk. We have a hard. There's certain. I think that's like another thing that I wish people would learn more. And it sounds like like you said, kind of the biggest thing that you've learned is knowing yourself, and knowing ourselves is so important in kind of learning in investing. And knowing your own biases, knowing your own failings, knowing your own kind of issues that you maybe not, I'm not talking about personal issues, but just kind of the way that you generally process information, the way that you view information, and things like that. Because being overconfident, I mean, that can ultimately be your own downfall. Always being humble in the face of the market is a very difficult thing to do.
And there's a reason why you've consistently seen money managers be the best stock pickers in the world. They were value investors. They weren't riding the coattails of some elaborate, intrinsic new way of doing things, right? New ways to value stocks, whatever it might end up being. The old process, the tried and the true way that was taught by Benjamin Graham, Warren Buffett, and Peter Lynch, all of which were value investors, stock pickers, trying to buy good companies at good valuations. And they just let the market do what it's going to do, because there is no such thing as a guru. There's only a market cycle. And the market cycle will favor, man, how many YouTubers did you see that were up and coming in 2020 and 2021? How many Substacks did you see come out? And everybody knew everything. And they were all wrong. And every one of them got burned. All the new ones got burned. And a lot of them, I'd say about 80 to 90% of them quit. And there's just a few left over now. And I'm 110% convinced that those who are still here after what we just went through with the macroeconomic picture, with the inflation, that was hands down the worst sell-off, if you were in growth, since 2008 financial crisis. Like, you can pull up Sky ETF, ticker symbol SKYY, and that was the worst software sell-off since the 2000. It wasn't even around in 2008. And you can even pull up just the NASDAQ in general. Dude, it was down for like 4 months in a row. That hasn't happened since the bubble in 2008. And it's like, that's what the Fed did. So it was.
And like you said, understanding the weather. You got to understand the weather.
And if I would have known back in 2020, QE, like as much as I know now, right? Because that's when I started to get into it. And if I would have known, there's no doubt in my mind that I would go back and I'd say, dude, that's a bubble. I probably want to buy some finance stocks because they're cheap. And right now I think growth stocks are cheap. Actually, I know that they're cheap, especially the profitable ones. Datadog is still too expensive though, but.
Yeah, no, I mean, I think, kind of looking at the market now, talking about another human, psychological thing is recency bias. People are afraid to get back in these names because of the recency bias of looking at that sell-off, and they're afraid that it's going to happen again, and they can't get themselves to get there. And that's not retail investors. That's professional money managers. They're the ones that ultimately control flows, right? It's the people that are moving billions of dollars, the asset managers, the retirement funds, Texas teachers, CalPERS, name like an insurance company. There's thousands of them. There's way too many insurance companies, but they're the one, and they're scared. They have the same recency biases that we do as retail investors. They like to think that they're different, but we're all people. We're all the same. We're not all the same, but we all have the same cognitive biases. We have all the same, kind of issues, and you can definitely kind of see that play out in the market, whether they want to admit it or not. Another thing I want to touch on is, like you said, it's like, tide going out, and a lot of these Substack and YouTubers, kind of disappearing. They got way overconfident. They were creating these channels, all these subscriptions and everything. But I actually think this event could actually be very beneficial for the retail investors kind of system, this whole ecosystem that's kind of developed, because it has gotten a lot of the quick hitters, people that were just being way too optimistic and not optimistic, opportunistic, and kind of jumping in and kind of taking advantage of it. But I think what it could build is kind of a bedrock of people like yourself, people, other folks that are out there that are committed to doing this and really enjoy it and are doing it for the long term and are truly trying to teach people, because that's what we need. We don't need the quick hitters. We don't need the people that are just, boosting one stock and just incessantly talking about it. That's not going to help the community. That's not going to help the kind of the whole system. But if we can, these, just like, I think, we're in a chat that, me and Dylan talk a decent amount in, and we talk about how, sometimes recessions aren't bad because they flush out, or, market pullbacks aren't bad. Recessions aren't bad because they flush out where capital shouldn't have been. It was misallocated. And when you get the tide coming back out, the bad companies kind of get washed away and the good companies remain standing. Well, you could say the same thing about content creators. You could say the same thing about research. You could say same thing about professional money managers. It washes out the kind of, the folks that maybe weren't as good or overconfident, kind of, quick hitting strategies, and it shows you who the best are. I mean, something that we talk about, we've joked about is, looking at Berkshire, looking at Warren Buffett getting back into deal making. All this stuff over the last 2 years, growth stocks, tech stocks, everything. And then where's Warren Buffett? Standing sturdy in the sand while the tide's coming out and being opportunistic and coming in and be like, oh, okay, now's my time. Now you're in my court.
Yeah.
This is my market.
It's like everybody's afraid.
The same argument.
I will start buying now.
Absolutely.
And I know that it was one of the most important learning lessons here too. And I think that I do think that even professional money managers, because you even see Peru, who's a proclaimed professional money manager, or retired, I should say. I think that we witnessed history in 2020, 2021, and early 2022. In a very important sense, that when you look back on economic and market history, it was comparable to the 1929 bubble. It was comparable to the 1999 tech and telecom bust. And if you even pull up the ARK Innovation ETF, the chart is identical to what the 99 NASDAQ looked like. What we ended up witnessing was the first major stimulative program by the Federal Reserve, printing $120 billion a month through QE. And what we witnessed was exactly how it affects financial markets and how easy it is for them to create bubbles. And more importantly, we also witnessed the true, like 2015, 2016 market, 2011, right? This is post QE. So you got 2008, December 2008, the Fed finally launched their QE program. Markets bottomed March of 2009. From there, you go from 2009 to 2011, and then that was going to be, I think there was actually one small QE program during that time, and then that was going to be the first time that we ended up seeing the markets go up, and it was very gradual. I created my own chart here. It's actually pretty interesting, where I pulled up the history of QE. So 2011 was the first time, and then from 2012 to 2014, we saw the identical thing, that while the Fed was buying assets, you saw just a gradual rise in the S&P 500, and as soon as they stopped, you ended up witnessing the market trade sideways for 2 years. 2 years, right? And you had 20% corrections in the S&P 500. But that was nothing to what's happened. And more importantly, you ended up seeing from 2016 to 2018, you think, why did we get that leg up, right? Why did we get that leg up without QE in the age of QE? And that was because of tax reductions. What you essentially did is Trump, when he cut taxes, he actually created more money in the system because the government was taking less money. So then that those earnings were going to all the investors out there. It was going to the employees, all those things. So it was a different form of stimulus. And that's probably why he did it in the first place, is because he did that stimulus through stock market. He gauged his performance on the stock market. And then finally in 2018, you finally started seeing that happen. But that was after the Federal Reserve ended up hiking interest rates all the way up to 2%, which is partially a way to slow down money creation. And they finally started doing balance sheet runoff. And then that's when things really started getting sticky, because they started sucking, think about it like a vacuum, taking so much money out of the economy. And then finally they had to pivot. And that's the classic Powell pivot that they like to say, or the Fed put, where they reduced the cash or the liquidity in circulation. I think it was like $1 trillion or $2 trillion they reduced their balance sheet by, so much to a point that, and it's identical what you can see from the markets. By the time that they actually started September of 2018, the Fed announced a rate hike and they increased QT, right? And it was at the rate of $40 billion per month is what they ended up doing. And then all of a sudden you started seeing the market sell off right after that. And I bet there was a lot of investors that didn't necessarily know what was going on during that time. And then the second, it was 2 days, no, it was 5 days after, 6 days after the Federal Reserve meeting that they ended up finally, it was right after OPEX, that Monday, the markets bottomed. But that's because the Federal Reserve changed pace. And you know that professional money managers are over there saying, this is the time to buy, right? Because they're saying, Powell's putting like he's gonna, and then after that they started cutting rates in 2019 because the markets were still like kind of stagnating. So then they cut rates that stimulate the economy even more, and then they did this. It's not QE4, but it was like this asset purchase program, right? It wasn't QE, but it was asset purchase program. And then you finally saw the true power of what the Federal Reserve can do in 2020 when they finally announced $120 billion a month, and $80 billion in treasuries, $40 billion in MBSs. And you saw this bubble that we haven't witnessed since 1999. That was historic. And in addition to that, we also witnessed 40-year high inflation. So we witnessed the combination between government spending and the Federal Reserve QE program. And this is this has never happened in market or economic history. No wonder we have 40-year high inflation. Because first of all, we got people in this administration that I don't think that they understand economics, truthfully. And then you got like with a lot of the gas policies. Come on, man. You reduce supply. It increases.
I think there's like a concept there that you hit on that I really like, and it's that it's not always as now figuring this out can be very complicated, but it's not always as complicated as maybe we want it to be, or that it appears, or the way the talking heads kind of talk about it. But you kind of highlighted a very important thing that like what. So you said we talked briefly, I think off is or maybe on is supply and demand, and okay, money. There's supply and demand with money, right? There's money supply and there's money demand, effectively. And when the Fed is putting more money, or the fiscal or monetary, monetary being the Fed, fiscal being the federal government, if they're pumping more money in, well, it's got to go somewhere. And it's not that complicated. You don't need to be now figuring it out. I'm not taking anything away from you, but figuring it out is complicated. But once you hear it, or if somebody hears you say it, or they figure it out themselves, or whatever it may be, it's not that complicated. If you're putting more money into the system, it has to go somewhere, and it's going to go into the market. And when you start pulling money out, it has to come from somewhere. And where is it going to come from? I'm not saying it's 100% from the equity market, but some percentage is going to be from the equity market, and it's going to come out.
Exactly.
It's not that complicated. It is. All the inner workings are incredibly complicated, and all the day-to-day operation, there's a lot of complication to it, and figuring it out is very complicated, and things like that. But once you kind of get down to that base level, it's like, well, there's going to be less money in the system now. It's got to come from somewhere. The equity market's probably one of those places that it's going to come from. So it's probably going to come out, and maybe I should adjust my investing strategy, my portfolio's approach to account for that. And where are the first things people are going to go? Probably the highest valuation names. It's probably the most popular names. It's the momentum names. And so you can keep some of those positions if you really believe them and you really love them, or not love them, because you never should fall in love with a stock. I never want to advocate for that. It's that you really like the fundamentals and that you really like its market position and all those kinds of things. But then you can start tinkering. You can start making adjustments. You can start kind of playing with your portfolio and kind of saying, okay, well, maybe you're really bulled up on Cloudflare, not you specifically, but one is really bulled up on Cloudflare. Well, okay, you can be bulled up on that. You can believe that they're going to revolutionize their industry, but look at the valuation and maybe reduce that position, take some exposure off, bring it back down, right size it, and then kind of move from there. And I think it's really hard to have that, and I really appreciate your kind of view on that, the longer term view, the higher level view, and then being able to bring it down to the micro, to the individual names and things like that. I think it's really challenging. It's really easy to get caught up in
It's the
things and to
boat
think that things
in
are
the
more
ocean.
complicated than they really are. Yeah.
And I love that you say that too, because there's so many different people out there that are trying to figure markets out through looking at charts. And I'm not saying that there's not something to it, because I look at charts all day too. I think every finance guy looks at charts. We love charts. But you can create patterns and observations with your own mind, and you don't even necessarily know it. And you can even see what a lot of people are doing on just FinTwit in general. I'm not saying that they're not smart people, but I do think that people overcomplicate this entire process by using things like moving averages, exponential moving averages, lines of support and resistance. The stock's going to do this if it goes do this, and they do it all in the name of trying not to lose money, right? That's what the whole point is. They don't want to lose money. They want to manage risk appropriately. And then in turn, we've seen this time and time. It's the same damn reason why my 15-year-old cousin was able to outperform the NASDAQ, because he didn't do anything. He bought a good company and he sat there and he just followed the company. And if it performed well, he left it alone. If it doesn't, then he sells it. And it's, if you understand the principles of microeconomics, of investing into individual companies, and if you understand the principles of macroeconomics, and then you understand what liquidity does and how it affects the financial systems, then all of it, everything else is noise. If you understand those two things, everything else, Russia, Ukraine, it doesn't matter. If people are sitting there posting, COVID didn't matter. Like, I know that it affected the economy. Yeah, it created trends in the stock market. That's why Peloton, one of the worst companies I've
Sure.
ever seen before in my life, actually ended up trading up the way that it did, is because of things that are going on out there. But when you think
Mhm.
about your personal investments that you are bullish on, the only thing that you should be focused on is the companies that you're investing into, and then the macro picture of liquidity. Like, is it a good time to buy or is it a bad time to buy? Everything else is
I
noise,
love that, and I
you
want to
know?
give us a chance to talk a little bit about current markets. But before we talk about that, I think the biggest conclusion or takeaway from this conversation that we kind of just had on becoming an investor, learning and stuff like that, is that it's not as complicated. It doesn't need to be as complicated as everyone makes it sound. It doesn't need to be as complicated as everyone wants to believe that it is, or the way that it may look on CNBC or Bloomberg, or when you read the Wall Street Journal or whatever it may be. It's not as complicated. You buy good companies that are executing, you follow them, make sure that you're paying a reasonable price, and that you follow macroeconomic trends, and you just kind of have a general understanding. Do you need to know exactly how open market operations happen by the Fed? You can if you want. It's very interesting. It's very intellectual. But if you just understand the higher level kind of tides kind of coming in and out, you can really simplify it. It doesn't have to be so overwhelming. It doesn't have to be this wall of information. It doesn't have to be this flood. Because to your point, what you said, it's so much noise. There's so much noise, and if you can just cut through that, learn how to kind of ignore it, and just focus on the things that matter, you can outperform a lot of people. You can outperform indexes. You can outperform a lot of people, and it's never 100% of the time. You're going to have years where you made a mistake. Maybe it's with the fundamental. Maybe of an individual company. Maybe it's that you had the Fed picture wrong. Powell pivots hard on you, and something like that happens. Okay, that happens. You take your lumps, you move forward, and don't overcomplicate it. Don't think that, oh my God, my whole investment process is broken. You should always be tinkering and tuning and fine tuning and kind of making adjustments, but don't let the noise distract you from a solid strategy. Like you said, especially if it's built on history, if it's built on kind of proven techniques, don't let the market shake that confidence. Um, so to jump into the current landscape, what are some of the main things that are on your mind right now when you're looking at the market? We kind of mentioned some stuff in this conversation, talking about quantitative, kind of tapering, where the Fed is pulling money out of the system. We have this war in Ukraine that's going on, and kind of jawboning between the two, Putin and Biden and Macron and all these folks. And then we have COVID. We hear about it coming back in China, and factories having to shut down. What is this all noise to you? Is this kind of, how are you thinking about it? How are you framing it? I know you said that you're coming out with a Substack here soon that's going to kind of reframe a lot of things and kind of talk a lot of kind of high level concepts and stuff. But if we could Maybe preview some of that, talk about the high level. Is this all noise? Should we be paying attention?
So I'm going to separate out what is noise and what's not noise, and then focus in on the things that are not noise. First off, the only thing that matters is corporate earnings, right? That needs to be understood for every single investor, right? That's why you see the stock market rally during war, because the government starts spending money and then corporate earnings start going up. That's what every investor needs to understand. So COVID, the illness, does not affect the markets. How COVID
Right.
affects corporate earnings affects the markets, right? That's what every investor needs to be thinking about. And like, I know that there's all sorts of yeah buts that could be going on in all sorts of people's minds, but no, the only thing that matters is corporate earnings, and that's essentially what drives the stock market up for the past 200 years. But when you think about the COVID situation over there in China, I almost think that this is going to be a propaganda move. I'm not exactly sure what's going on in China. I don't think anybody really truly does. We never know if their numbers are going to be accurate or if they're not going to be accurate.
Right.
And in my perspective, I think that that's going to be a lot of noise, because the truth is that the voters of America have spoken, and they're starting to speak even louder, more and more, when they're saying that we're just done. Like, and I'm not saying that we're done, but I am saying that I think a lot of people are really starting to get the fatigue of it, and they do trust the vaccines and they do trust the therapeutics that are coming out. So I do think that anything COVID related would more or less be noise. And more importantly, I think the federal government and the federal governments all over the world know that they cannot lock down the economy again. Unless they want the next Great Depression, they cannot do it. They can't do it. So it's like COVID, that's noise. When it comes down to the Russia and Ukraine right now, that's noise. And the reason why I say that, unless there's only one scenario here, nuclear war, right? You should be paying attention and seeing if there's going to be nuclear
Yeah.
war, because that does affect the economies of the world. But as it stands here today, what's going on over there, you know, God bless the Ukrainians, man. Putin, he's doing all sorts of weird stuff over there. And I think it was a big mistake. I think it was a big mistake by Russia. And even China's starting to get on board and saying, man, you can't be doing that. That's stupid. And they did make a mistake. But when it comes down to the financial markets and how it's going to affect corporate earnings, the commodity prices was the biggest thing that I think that the markets really had to digest, and especially gas. But I do believe that they had their 2 weeks to hiccup over this. I do think that that's why the markets did end up selling off pretty hard, especially on the war news. Um, the markets had the opportunity to digest what's going on. And I think that anything from here on out, unless there's going to be any sort of escalation or in conflict involving other nations or nuclear war, it's all noise, especially from a financial perspective, financial market perspective. The only thing that matters in my mind right now, and this is what it probably occupies a majority of my thoughts during the day, is inflation and what that means and what is really going on. So let's think about history and what the stock market is doing today, and what history would suggest that the stock market is going to do next. In the age of QE, because QE was first ever implemented in 2008 in America. In 2001, it was implemented in Japan. And what we know is that when the Fed prints money, the markets go up. What we don't know is what ends up happening when there's so much liquidity sloshing around out there that we have $1.7 trillion in reverse repos, and then we have bank reserves at an all-time high, and then we have a slowing economic environment. This to me is the most concerning. I posted a Substack saying my warning to all investors, and a lot of people probably thought I was doing fear mongering, but that wasn't the case at all. What I've come to know is that when the 2008 financial crisis ended up happening, they created, and this is what a lot of people don't think about, is that they actually created a new economic system based on quantitative easing and zero interest rates. And right now, the federal fund rate is going to be in between 0.25 to 0.5, which means that they're still historically low, like very, very, very accommodative policy still. And even though that they haven't even started their balance sheet runoff, So that these are all variables that I'm thinking of, and I just think about, okay, well, the history is going to suggest that if they start raising rates, and that if corporate taxes don't change, and they start doing quantitative tightening, that the market should realistically crash, right? But there's a big, massive variable here. 40-year high inflation, $1.7 trillion in reverse repos, and bank reserves are at super high levels. So if we were to assume that corporate earnings matter, and if we were to assume that liquidity drives markets, and if we were to assume that valuations are affected by the 10-year yield on the equity premium, then the only solution that I can really think of here is that we pull a repeat of 2015 to 2016. That's the only thing I keep on thinking about, because when we look at the forward PE on the S&P 500, I think Apple's PE is still like a forward PE of 30 or 32. It shouldn't be that high. And there's a lot of other large caps right now. What I wouldn't be surprised to actually see here is, and I posted this too on my Substack, and it's pretty open. Like when you see my Substacks from the November timeframe to now, I post all of my thoughts all along the way, right? And a lot of them, I'd say about 70% of them are pretty spot on. Sometimes I miss the mark, but 70% of them are pretty spot on, because going back to what I think the markets are going to do next, when you think about the excess liquidity of the markets, but people are still paying more attention to valuations, one can easily draw the conclusion that we are not in a bubble right now in any way, right? Because valuations
Okay.
do matter. People don't necessarily want high beta. But I think that the bubble is actually going to be in large cap tech stocks. And the reason why I say that is that inflation creates this risk adversity. And they say that small cap corporate earnings they're all going to go out of business because inflation impacts small caps the most. So if we start seeing inflation actually abate and it goes down, I wouldn't be surprised to see that the stock market trades sideways, because people are still going to want Apple and Microsoft. I'm not saying that at all. I'm not saying that
Yeah.
they're in a bubble and they're going to decline 50%. What I am saying is that I think that a lot of institutions are hiding in those. And I think that the flow of capital is likely going to go to the other parts of the market that have been decimated, especially if inflation goes down. If inflation goes down, growth stocks, small cap stocks are going to fly. And, and that's just because that's where the market's beating them up the most. And that's the only thing that really makes
Mm-hmm.
sense. And that's why I'm still buying growth stocks right now, is because you do have these really, really great companies that are trading at historically low valuations at the bottom. They're comparable to the bottom of the 2018 crash. And now we're in a situation here where liquidity is not scarce, it is abundant. And we could even potentially be in a situation where the Fed could do roll off, balance sheet roll off. And the only thing that we really end up seeing is just more of a normalization of the markets. Not necessarily going to be in the equity markets, but more of a normalization in one large caps, tech stocks, and then also the reverse repo market. And I think that they even mentioned that in their Fed minutes as well, where they would need to see that normalization, the reverse repo markets. This isn't healthy. There's nothing healthy about this. So if I were to just make this super simple, right, based on everything I just said, I think that the markets are going to trade sideways. I think they're going to trade sideways for a little bit longer than what people would expect. But I think the markets are going to trade sideways, but what's going on beneath the markets won't trade sideways. And I think that I think capital is going to flow back into the areas that the markets have beaten up the most. I think that high growth stocks, because their valuations are comparable to the 2015, 2016 levels now, I highly recommend following Clouded Judgment or at Jam and Ball. He pulls up the chart, and I watch that chart all the time. And the valuations are comparable now, meaning that they've come down, and they are normalized. But if you have a company that is at a normalized valuation, growing at 90% year over year, assuming it doesn't need multiple expansion at that point, right? So then the returns, then you could assume that you would get, assuming the company executes and assuming that the multiple doesn't change, 90% returns,
You're
right?
you're not making an investment based on multiple or anything. You're just saying, and this goes back to investing in good businesses. If this business just executes, I don't need anything else. I don't need the market to be in this positive go-go mood. I don't need the Fed's liquidity, kind of, excess piling into the market. I don't need any of that. If my company just does what I believe it's going to do based on the fundamental research that I've done, the, kind of belief in management, belief in the products that they're selling, whether it be software or, physical goods or services or whatever it may be, that's a great place to be when you don't need to rely on multiple expansion, when you don't need to rely on the markets. I mean, you're just relying on good businesses, and you're saying markets can do what they want, and if valuations come in tighter, I'll buy more because
Yep.
this is based on, like, how much they're growing. They shouldn't be trading lower. It doesn't make any. It doesn't. We could get real deep into, like, the nerdy, like, discounted cash flow. If, folks, you can Google it. Kind of discounted cash flow model is the base on kind of what finance is kind of based on. It's, finance is all, at the end of the day, discounting your future cash flows. It's how much money you're going to make in the future. What is it worth today? How much risk is in it? It's actually pretty simple. Those models get insanely complicated, but you don't need to get into the details of those models to really understand it. And then you don't, and then you get that's when it's like, what is it Benjamin Graham, the margin of safety, where you have that margin of safety where you can buy it down, you can feel good, and you can kind of trust and rely on the business and just in the fundamentals of finance. You're investing in, not relying. You're investing in the fundamentals of finance and the fundamentals of a business, and you can't go wrong with those things.
That's right, man.
You you can't go wrong with those
Nobody's thinking
things.
like that right now.
I know. I
Everyone's
know.
thinking right now, they're
It's
thinking that I got to chase the oil trade. What's the next trade? What's the next macro trade? Guess what? Valuations are still really high on the S&P 500. They're 18. Forward PE is 18. And the median is going to be 13 to 15. But I do think that the government and the Federal Reserve is going to do what they can to prop up people's 401ks. And I do think that a lot of this stuff is centrally planned. The only thing that there's one major risk is that I see here. I'm saying that my scenario that I talked about is the most likely in my most optimistic scenario. But there's also a scenario here that I'm very, 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 very concerned about. And I think that everybody should be concerned about. Remember the principles of liquidity, right? And what the Fed did in 2008. Whenever the economy ended up slowing down previously, the Fed essentially ended up printing money. And if you wonder why they did this in the first place, it's to prevent a credit supercycle, right? Because everything works in cycles, and Ray Dalio talks about this all the time. And what you essentially see from 2008 to now, like 2015, that was a portion of the credit cycle. In 2018 was just a portion of the contraction, because like there's a bunch of mini cycles and a much larger cycle, right? And I believe that when 2008, we ended up seeing a large contraction in the credit cycle. My concern is that if this economic slowdown that in the 10 and 2 year look like they're going to invert, and historically that says that there's going to be a recession in the next 12 to 18 months, if they do invert and if they stay inverted for a long enough period, one could only assume that there's going to be an economic recession. Anybody can say that. The question becomes, what if credit starts to contract? And if credit starts to contract when inflation is at 10%, because I think March is going to come in probably around 9.5. Maybe they might manipulate the numbers. I don't know. But I think it's going to be high. I think it's going to be a little bit higher than we think. And it's because of gas, commodity prices, things like that. Food prices are going up. The price of everything is going up. If we go into an economic recession, that we don't necessarily know how deep or shallow this is going to be. If it's shallow, then what I'm talking about, my first scenario, and I think that that's probably what's going to happen, is that's what's going to happen. Like, because of just valuation multiples, depending on good businesses, just history, right? What history would suggest would happen next. But if it becomes a massive economic recession, and if the Fed can't do what it did in 2008, because what are they going to do? Slash rates? They're 0.25% right now,
can't.
right? They can't do what they've done since the 1970s, right? They can't do what they've done for the past 100 years. And even in the 1920, the great financial crisis, when they slash interest rate, government spending up, boom, you offset that inflation and deflationary pressure. So what happens when deflationary rears its ugly head and we still have hyperinflation, right? That's stagflation, man. And this is exactly how empires have toppled. And this is what I'm saying is like, you got to understand what the weather is going to say. Like, are you going to get into a hurricane? Because nothing is, business fundamentals aren't going to matter when that happens. And my biggest fear is if we do start to see the deflationary pressure, and if people start defaulting on their loans, and maybe where there's a bubble, just like in 2008, majority of people didn't see it. Majority of people didn't know where it was. But in 2008, the bubble was in the housing market, and we don't know if it's in the housing market again because the prices are just ridiculous. And what happens if people start defaulting on their loans? What happens if the entire financial system starts doing a 2.0, what it did in 1929 and in the 1970s and in 2008, right? We don't know if this is going to be the case. And I think that every investor should be paying attention, professional money manager or not, should be paying attention to what is going on in the economic environment. And I think that that's the only reason why the S&P is still in correction territory, is because the economy is strong and the labor market is strong. And maybe it is just going to be a nice shallow recession where we see just enough to that soft landing that they're trying to manufacture, right? If it is a soft landing and it's just nothing more than, hey man, we just had a couple great years of GDP growth, now we're just going to pull back moderately, and then we're good. Then the markets actually do see that soft landing. But if we start to see some sort of credit contraction similar to what we saw, in previous times in history, my fear would be a 40 to 50% downward turn in the S&P 500, because that's the only thing that would seem logical at that point, because that's what history would suggest. So I think that if I had to give a quantitative, like, what do I think is going to end up happening? I'd say like 80% chance we're going to do scenario one, 20%
Right.
chance we're going to do scenario two.
I think that's an important thing for people to have in their minds too, is that you have to be able to have kind of multiple views kind of at the same time, is that you don't have to be dogmatic believing one thing. You don't have to be, 100% in one camp, because you're not, it doesn't sound like, at least you're not investing solely protecting for that 20% scenario that you said that could play out, stagflation, and really kind of putting the Federal Reserve in a bind, really putting in the federal government in a bind where really their hands are tied. They can't really do anything, because then it just, for stagflation, it's, for people that don't know, it's like when interest rates are low, when unemployment starts getting high, and or I guess, sorry, when inflation is high, when unemployment's high and growth is low. And then what it prevents is the Federal Reserve. What they need to do is raise rates to prevent inflation. But then employment and unemployment's high, so you can't do that, because then you're going to cause the economy to go further into a kind of a downward spiral. So it ends up kind of tying their hands in terms of what they're able to do. But you're not necessarily, you're able to kind of always have your kind of watchful eye out, kind of monitoring, and then maybe your odds go up, maybe it's 25, oh, maybe it comes back down to 15. You can always kind of dial that up and down based on new information that's coming in. But at the same time, you can't solely invest based on that, right? Like, you need to, again, the 80% scenario on the other side, but always kind of having a watchful eye. Just kind of like you mentioned when we were talking about, you brought up Ukraine, Russia. A lot of it's noise, right? But you always kind of need to keep a watchful eye. It's not saying don't read the news at all. It's like, read through it, and it can be very interesting from a human perspective, from just a geopolitical perspective. It's just, interesting to follow, but always kind of keeping your eye out. Okay, what I really care about here is nuclear war, the potential for that, because that could be disastrous. And same thing here, like, okay, I don't think stagflation is going to happen, just like we don't think nuclear war is going to happen. But I always got to keep my watchful eye out and just kind of pay attention. Like, okay, are those odds increasing? Is something happening here? Okay, it's seeming like yes, it's seeming like no, and kind of adjusting that mental model. And kind of, you don't have to be a super bear and say, oh, the world's going to come to an end. There's a 10% odds that nuclear war is going to happen. Like, okay, well, hold on, slow down. Like, let's not, you don't need to let the small percentage just blow up in your mind, but keep a watchful eye out. And the same thing I think can apply to companies, right? It's like, you really think that a company is executing. You really think that things are going well. You're looking at all the metrics. You're listening to management. You're following the product actually out in the market. You're talking to the software developers, doing all this stuff. But you're always kind of watchful. Okay, everything's going really well, but there are some risks, and I recognize that. It's not a riskless investment, and I always just need to keep my eye out for those kind of like smaller risks that could end up being very big risks. And it doesn't need to mean it needs to dominate your investment strategy. It just means that you're paying attention. You're keeping an eye on it. You're making sure that it's there.
Exactly.
But
And that's what
yeah,
I'll always keep trying to post about.
yeah, man. Well, I really appreciate the time that you spent with me today, Dillon. Is there any kind of last thing that you would want to kind of leave viewers and listeners with? Would love for you to, kind of, mention your Twitter and your Substack, and kind of highlight those kinds of things. Would love, people definitely got to go check you out. You're one of my favorite follows on Twitter. I subscribe to your Substack. It's some great content. People should definitely go check it out. But and BluSuitDillon without the E in the blue is Dillon's handle, and anything you want to leave folks with.
Yeah, I think I want to go back to the lesson, the number one lesson that I learned, and really just leave that with the audience that you have here today. Um, Trust yourself, right? Trust yourself, understand, learn, seek to understand that this process doesn't need to be more complicated, that corporate earnings are all that matter, and that over time, if a company produces more earnings, the price of the stock goes up. That's is about as simple as I can make it. There's all sorts of different things that you can do to increase your odds of success of picking a good company. But if you do that, I mean, you're going to be like my 15-year-old cousin that bought Tesla and Apple, right? And he's outperforming the markets. And it's really that simple. And there's a lot of macroeconomic things that are going to be on out there, but just think about liquidity. What's going on with the tide? Are you going to be the sailor that's going to try to sail across the ocean only knowing about the boat or only knowing about the weather? Or do you think it's wise to do both? And always trust yourself, your decision making, because nobody cares about your portfolio more than you. And in addition to that, nobody knows your personal financial situation. And that's actually 70% of the reason why I am still here. The other 30% is because I was able to grow and evolve through these market cycles. And it's going to be like that for the rest of my life. But because of my personal financial situation, because I have, thousands of dollars in excess cash flow on my income statement, then it makes it possible. It makes it possible to continue to buy the dip and accumulate business equity over time. And also, like I mentioned before, stay the hell away from margin. Just get off of it. Don't like if you don't know what you're doing, hedge funds
I
blow up,
love it. It's
professional
so
money
true.
managers do it.
Yes,
My gosh, it's not that hard, and people still do it.
I know. I know
It's
it
going to kill
is.
your
It is.
returns.
We are all human. But Dillon, I really appreciate your time. Really appreciate you coming on with us and letting people get to know you a little bit better, listening to your process, listening to you as you think about things. I really appreciate it, and I know we'll talk again soon.
Yeah, thanks for having me here, Josh. Appreciate it, man.